Now, I don't have to tell you how important it is to track every penny. One way to do this is by using promissory notes. Businesses use these notes for a couple of reasons. For example, like Summer, maybe a business loaned money to another business. Or maybe a customer or vendor is overdue on a payment and now are agreeing to a payment plan with interest. Regardless of the reason, promissory notes are essentially contracts that need to be accounted for on the balance sheet. Let's hear from an expert with some advice about working with promissory notes.
So a promissory note is basically a loan. A couple of things you need to look at when it comes to a loan. It's going to be a liability on the balance sheet. So that's the first place you're going to add an account. The question is it going to be a short-term liability, which usually means it's paid off within a year or so? Long terms would be longer than that, more than a year. Maybe it's a mortgage or a car payment, something like that. So it's a long-term note, and you need to make sure that you choose the right type of account so that is reported in the proper area on the balance sheet, short-term or long-term. Things to look at when you're looking at that actual loan document, there might be a certain amount of that, the fees for processing the loan might be something that gets written off. There's the loan balance. And so you need to kind of check out what can be put as a debit on the profit and loss as a business expense. There might be processing fees or something like that. But basically, the entire balance that is going to be paid off should be listed as a note payable somewhere up on the balance sheet, either long-term or short-term liability.